When it comes to making money in stock market, two methodologies come to mind: trading and investing. Trading focuses on catching a short-term move in the price of an asset to make money, whereas investing is focused more towards fundamental value of a stock, which means that you hold a stock for years, if not decades, to make money. On one hand, we have highly successful traders like Paul Tudor Jones, Richard Dennis, Jesse Livermore, Jim Simons, etc., who made billions in trading. On the other hand, we have billionaire investors like none other than Warren Buffett, Charlie Munger, Ray Dalio, etc. So, there is no doubt that money can be made in both types of methodologies. What differs is the time and effort that you're willing to give. One is focused on short-term and quick returns. The other focuses on long-term commitment with huge returns. In today's video, we're going to discuss the differences between trading and investing and finally decide which one is more profitable and which one should you focus more on. So without any further delay, let's get started. Part 1: The time difference. In stock market, the stock price fluctuates up and down depending upon its supply and demand in the market, and in doing so it forms a wave-like chart pattern, where sometimes it rises, sometimes it falls, and other times it may remain sideways. Trader focuses on catching the short-term price movements to make money. He uses technical analysis and his systems to judge the upcoming direction of the price movement and bets on that. Whereas in investing, you focus more on what is the long-term fundamental value of the stock. Investors are not concerned with the short-term ups and downs of the price. They play long game where they remain invested in the stock for years, or even decades. As Warren Buffett, one of the most successful investor, popularly quoted, "If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Investors buy shares based on what they think the company is going to do, and how will it perform in the next years. Part 2: Risk tolerance. When it comes to risk tolerance, trading and investing differ significantly. Trading generally requires a higher risk tolerance compared to investing, because you're essentially betting on short-term price movements in the market. The goal is to buy low and sell high or vice versa within a matter of days, or even hours. This means that you're constantly exposed to the volatility and unpredictability of the market. One wrong move can lead to substantial losses. On the other hand, investing is more about playing the long game. Investors are willing to hold on to assets for years, or even decades, to capitalize on the overall growth of the market. While there's still risk involved, it's generally lower than the high-stakes world of trading. A classic example would be a buy-and-hold investor who steadily contributes to their diversified portfolio, weathering the market's ups and downs to achieve steady long-term profits. In essence, trading requires a more aggressive, high-risk mindset, while investing is better suited for those with a lower risk tolerance and a longer-term outlook. The key is to understand your own risk appetite and choose the approach that aligns with your financial goals and personality. Part 3: Strategy difference. The strategies employed by traders and investors differ significantly. Traders most commonly use price action and technical analysis to try and predict and profit from short-term fluctuations. They analyze chart patterns, indicators, and other technical data, such as volume, etc., to identify potential entry and exit points. They also use news and events to sometimes predict price movements. We have talked a lot about trading strategies on this channel. You can refer to them for more details. Investors, on the other hand, take a more long-term approach. They focus on fundamental value of a company or asset, with the goal of achieving steady, sustainable growth over time. Some common investing strategies include: buy and hold, investors who purchase stocks or funds and hold them for the long term, often for years or even decades. Value investing, investors who seek to identify undervalued company with strong fundamentals and potential for growth. Index investing, investors who build diversified portfolios by tracking broad market indexes, such as the S&P 500 or Nasdaq Composite. While traders are constantly on the lookout for short-term opportunities, investors are more concerned with the long-term potential of their holdings. The key difference lies in the time horizon and the level of risk each approach entails. Part 3: The profitability difference. When it comes to profitability, both trading and investing can be lucrative, but the paths to success differ significantly. Traders often have the potential for quicker and more dramatic returns, but this comes with a higher level of risk. Successful traders are able to capitalize on short-term market movements, using their expertise in technical analysis, market timing, and risk management to generate profits. However, the high-stakes nature of trading also means that losses can be substantial if a trader makes the wrong call. Imagine a day trader who perfectly times the market and doubles their money in a matter of days, but then loses it all in a single, ill-timed trade. On the other hand, investors typically take a more measured and patient approach to wealth building. While the returns may not be as immediate or eye-catching as those of traders, investors often enjoy more consistent and sustainable growth over the long run. By focusing on the fundamental value of companies and assets, and holding them for extended periods, investors can benefit from the power of compounding returns. A classic example would be an investor who steadily contributes to a diversified portfolio, such as a Roth IRA, and watches their wealth grow exponentially over decades through the magic of compound interest. Apart from asset gains, they also sometimes get dividends, which also contributes to the net profitability of investors. Profitability of trading versus investing depends on a variety of factors, including individuals' risk tolerance, market knowledge, and time commitment. Trading requires higher risk tolerance, much more effort, and still the chance of success are pretty low, because of discipline and mental strength it takes to become a profitable trader. Investing, on the other hand, is more like set and forget. Once you do your research and find the perfect stock to buy, you just buy it and forget. Like I discussed earlier, there are people who made billions of dollars in investing, and there are traders who made billions of dollars in trading, which proves that money can be made in both. What path you choose is entirely your decision. Let's come on to our initial question: what should you choose? What's best for you? It all comes down to the time and effort you're willing to put in and the amount of risk tolerance you have. If you're the type who craves the excitement of the market's daily ups and downs, trading may be the adrenaline-fueled adventure for you. But be warned, the high-stakes nature of trading also comes with the risk of substantial losses if you make the wrong call. On the other hand, if you're more of a tortoise than a hare, investing may be the steady, sustainable approach that aligns with your financial aspirations. By focusing on the fundamental value of companies and assets, and holding them for the long haul, you can harness the power of compounding returns and build wealth over time. Ultimately, the race to financial success is your own. Whether you choose to sprint towards quick gains or jog towards long-term growth, the key is to understand your own strengths, weaknesses, and risk appetite. Diversify your approach, set specific goals, and stay disciplined, and who knows, you might just end up crossing the finish line as a champion in your own right. Please like the video if you and subscribe to the channel for more such videos. Thanks for watching, and I'll see you in the next one.